ended at that class. I had to go through the video to ensure that we stopped there. So we'll be continuing on the section 3 of unit. What unit were we on now? Pardon me, let me toggle my screen back. Okay, unit 3. That's the business risk approach. So we've spoken to the development of the audit strategy and practices, and we've spoken to the meaning of the business approach, business risk approach. So the third unit, or the text section we'll be looking at, is the nature of the business risk approach. So let's try to run as we have this conversation around section 3, which speaks to the nature of the business risk approach. Okay, so speaking to the business risk approach, we've looked at the introduction in the just concluded section. So we'll be looking at the business risk approach, talking about the inherent control detection risk, the AR model. And the business risk approach goes beyond looking at this model. It starts earlier with the business itself. So key features of business risk is the entirety of the business. You're looking at holistically everything that has to be done, that has to do with the business from top down, talking about strategy formulation, strategic direction from the board, from directors or owners. And it starts with the top. So we're talking about the business model, those that formulate the model of the business, strategies, and the environment, macro and micro. Then from the top, it cascades down to the bottom with the financial statement, which reflects business results. So before the result, there is a process. And from the top, the process starts. The creation of value down to the bottom line that provides the financial statement. So the business risk approach you look at from the top. The head or the apex part of the organization provides direction, provides this is what we want to achieve, this is our objective, this is our goal, and it will cascade down to the results, which is the financial statement. So in auditing, auditors should look at from the top, what are the strategies, what are the business model, what are the macroeconomic and microeconomic environmental factors affecting the business. Not just looking at the financial statements to see what it culminates in, the numbers and all that. So the business risk approach talks about us looking as auditors from the top. What are they doing at the process? From strategy formulation, the process that leads to the product, which is the financial statements. So business activities drive the numbers in the account. It's important to take note of that. The activities from strategy formulation, from tactical and operational area of the business, they drive the numbers. So the high level focus should be similar to management strategy, and it requires understanding of the business entirely. It's where the industry is domiciled, the sector, and you look at also future trends. What are the futuristic plans of the business? Also, it will help you better understand risks by identifying business risks, and we need as auditors to gain deeper insight into inherent and control risks that affect this business. We also need to look at industry specialization. Large audit firms, mostly the big four, often use industry experts or specialized audit teams to properly apply this business risk approach. And it matters because the auditor looks at the business risks only in terms of their potential effect on the financial statements. So the business risks, you have to align them from strategy, top, tactical, operational, to see how it has effects on the financial statement, either positive or negative. So an example for example, a bank heavily exposed to digital banking. Everything about the bank is digitization, tech savviness, everything is cyber. So a tech savvy business like that, you must look at cyber security risk, which are emerging threats or failure of IT. Sometimes you get to the bank, you hear there's no network, but that same bank will collect money and keep it. Disburse money, or let me take my money, they'll say no network. So risks around that could damage customer trust and operations. So auditors need to look at, for example, a bank in that ramification or that direction, because the impact focus on IT controls, data security, and disclosure of risks in the financial statements. Another example is a pharmaceutical company awaiting government approval for a new drug, maybe that has just been discovered, or research and development in another country has just brought that drug, and the government, or let's say for Nigeria, has not allowed it to be shipped into Nigeria. So that pharmaceutical company could be waiting, and a business like that, the business risk could be delay in approval, which could affect revenue forecast and revenue results also. And the impact could be the auditor evaluating assumptions in revenue recognition, research and development, capitalization, and going concern issues. So this example of a bank, first speaking to the issue, then you look at the business risk and its impact, is a way auditors, or are ways auditors could assess a business from top down to bottom. You look at the business, you look at its impact, or the business risk and the impact on the business, and how it will culminate in impacting the financial statements negatively. So we have two sectors, the banking sector, we have a pharmaceutical company example, and how the business risk and how the impact, the audit impact, could affect the business. So you're looking at the bottom line and drivers that could affect the bottom line negatively. So what is risk management is to, in simple form, avert danger or negative effect on the financial statements and help the business put mitigants in place, so it will culminate in a positive bottom line for the business. Not just looking at financial statements, how they are posted, how the lines are recognized, in recognition criteria and all that. No, those are the technicalities of financial statement. But you want a business to be sustainable, and that is why you need to look at it from a business risk perspective. And that is why the nature of business risk is very important for auditors to take note of. So a key takeaway as we close down this session is that business risk is not about numbers or the financial statement. It's about understanding the client's world, what they are doing. Don't just get your audit fees, you've ratified, certified the financial statements and move on. No, the auditor should connect strategic risks to tactical risks to operational outcomes, and then the financial statements. That's how pragmatically and the current day auditor should approach a business in the sense of business risk approach. So those are my thoughts on that. You may not find some of this content on the study text, and that's why I advise you, please go through the study text also. Somebody asked me, will it be all right to just go through your slides and your videos, the past questions? And the answer is yes or no, or yes and no. Yeah, you can go through the slides and still pass, but I will be more comfortable to advise you to please go through the new study text. I know it's 600 and something pages, about 630 to 650. It's voluminous, but I think with a good plan on ground, you can finish that in a month. So please try to go through the study text. Use this as a secondary sharp tool. You can just navigate through your phone, the slides. The past questions are non-negotiable, of course. Those ones you have no choice. You have to go through them. But then please, I would suggest you go through the study text. Everything in the study text, you might not see it on this slide. And some of the content of this slide, you might not see in the study text. So add the two heavy combos, and I think you are good to go. So please read the study text together with the slides. That's my advice. Okay, so that's a brief on the nature of business risk approach. Any question, contribution? So please, as usual, feel free to interject. If you have any thought that struck, or I said something that's not clear, please feel free to interject, so we provide clarifications as much as we can. All right, any questions? So we'll go on to the next section.
So I don't know, I can't see your slide. I don't know if okay, I can see it now. Thank you.
Oh, okay. I think if I stop toggling, it will go off on some people's screen. All right. Thank you very much. And I think the next section will be internal business risks. Internal business risks. All right, so let's look at the next session on internal business risks. Okay, internal and external business risks. So when using the business risk approach, auditors must identify both external and internal risks. So internal risk speaks to the ones bedeviling a business from outside, talking about opportunities and threats. Then internal risks talk about strengths and weaknesses. So since both these risks affect the client's ability to meet objectives and culminates in an impact negatively on the financial statement, the external business risk from the outside is beyond the company's control. For example, the loss of a major contract due to disputes is beyond the company's control and could culminate in decline in product demand and poor research and development investment. Another risk could be new competitors entering the market, having the market share and sharing the volume the former company has. Issues like regulatory changes, maybe license withdrawal in a financial services company. These are external business risks beyond the company's control. Also, technological disruption are risks, business risk, macroeconomic shifts, for example, interest rates, forex issues, recession, natural disasters, storm, flood could negatively impact operations. So another one is competitors challenging patents, copyright. So these are various forms of external business risks and examples. And the impact is that it may affect the going concern of a business. That's why auditors need to assess these risks. Revenue recognition could be impacted, asset valuation, and disclosure requirements. So these external business risks need to be assessed and their impact also by auditors severally. Also, internal business risks are those that arise within the company itself. I spoke about external, I said opportunities and threats, while internal strengths and weaknesses. And the internal business risks often are controllable through management because they are internal. So, for example, ineffective employees or weak management. In simple form, it may sound harsh. Fire them and get new staff. That's it. You can control it. If you're not doing well as a management, you resign. Leave the stage for somebody to do well. Or if the employees are not doing well, you fire them. Simple. And hire good ones that will do the job. So those ones are controllable. Cause poor customer service leading to sales decline. Fire the customer care. Or train them. Okay, let's not be too harsh. Train them. If they are not still doing well, the result, fire them. Get those that can handle the customer care service. We have AIs now doing fantastic job on customer service. So these are controllable areas management could handle. Another area, weak financial management, talking about high gearing, poor cash flow, bad working management. You train the management team, the finance team. If they don't do well, you fire them and get better people to do the job. Areas of lack of funding for capital investment, management could divest, work on the capital structure of the business, restructure, reorganize to get more funds, get equity, or dilute the business to be a debt, go for debt. Just do something to get funds to. So internal control weaknesses or IT system failures are within management's purview. They could work on it, get reliable and good hands to handle those areas. Overdependence on one or two key individuals that if they leave could disrupt operations are areas that could be handled by management. Train, retrain, and upgrade staff, have backups and all that. Risk of fraud or misappropriation of assets are also internal risks that could be handled by management. They are primarily responsible for this. And the impact of internal risks may affect internal control, reliance, cash flow assumptions, asset impairment, and fraud detection procedures. So it's very important to assess internal business risks and their impact. Very, very key because these are controllable by management and management can handle it and put the organization on a positive trajectory. So students should apply this in exams. Take note. So you could be given a case study to identify internal and external business risks from a scenario. So explain how each risk could impact the company's ability to achieve its objective, not just financial statements. You see, the objective of a company is very important first, and that will culminate in its bottom line, which is the financial statements or the numbers. It's key. So try to link the risks to its potential audit implication, impact, effect. For example, going concern issues, disclosures, sustainability issues, asset valuation, control testing issues. So a quick scenario, for example, an airline. The external business risk could be new competition offers for cheaper routes, new airlines coming, may reduce revenue for another airline. So you need to test revenue recognition and access going concern. These are external business risks. For an airline, you could handle. And for internal business risks for an airline, weak cash management, liquidity issues, reviewing working capital and disclosures could be areas you could handle for that airline. So key takeaways for the business risk area is that internal and external business risk are only relevant to auditors insofar as they impact the financial statement. So any risk internally and externally that would affect the performance, the position of the business will impact the financial statements. Very important. So the auditor's role is to connect the business realities. What are the business realities? What are the risks that will impact our business and would in turn impact the financial statements? This is very, very important. So that's it. Speaking to internal business and external business risks of a business. So we need to look at that holistically because that would lead to the numbers. If a business is doing very bad, the bottom line, of course, will be bad, and the reporting of negative outcomes in the financial statements would not really help the business stay sustainable. So sustainability is key, and auditors need to look beyond just financial statements, technicalities, postings, recognitions, and look at what bedevils the business internally and externally. Very important. All right, so that will be the end. I'm trying to rush my thoughts because we don't have much time. Any questions on section 4? Any questions? All right, I hope it's sinking and comprehensive. Let's look at section 5, risk evaluation. Risk evaluation. Now, risk assessment is very important for auditors. That's the first thing you do before taking up an audit assignment. Risk assessment is important because in assessing the significance of risk, not all risks matter equally to auditors, and that is why the current risk-based approach to attending to audits is very important. The significance of a risk depends on two key factors: the impact, materiality, the significance of those events. How big would the effect be on the financial statements if that risk crystallizes? And that's very important for the auditors to take note of. And also the likelihood of risks. How likely is that the risk will actually happen? So when you are assessing risk, you look at its impact and its likelihood. You are being proactive, and that's why risk management is much more proactive and not reactive. So auditors often use a risk matrix to prioritize focus. So the impact and likelihood, you look at it from a high, medium, low method or perspective. So the high impact, you categorize it red, high, and the low impact, you categorize it yellow, and the medium impact, you categorize it amber. And if the risk will not crystallize, you look at it as green. So these categories are what auditors and risk managers use to categorize risk. What it means for auditors is that category 1 here talks about high impact and high likelihood. That is the red. So you need to prioritize that risk. Any risk that falls within this threshold must be prioritized and attended to first. Is critical for the business. So for example, the high risk of revenue manipulation in a company where revenue is the most material item Of course, the materiality threshold will be based on revenue if the company relies on revenue. So that area or that component of the financial statements must be treated critically and highly. Number two, the category 2 speaks to the amber, and it talks about high impact and low likelihood, which is medium. And it's still important, but not as the first one because it's due to potential impact. So, for example, the loss of a factory due to rare natural disaster. Yeah, the auditor may check insurance cover and check other risk management mitigants in place that could have averted that disaster. So that's a medium impact risk, and category 2 would help put not a high attention or high critical attention to it, but a medium attention to that. Then for category 3, risk talks about a low impact but high likelihood, and you see that as yellow. And it's a more frequent but less material risk. So for example, small clerical errors in expense postings, expense claims, it could culminate in low risk, and that would require little attention. And that's based on the risk-based approach to attending to risks. And category 4 speaks about risks around low impact and low likelihood. So that should generate lowest priority or attract low attention. So the auditors generally spend minimal time here. So for example, petty cash shortages, 50 naira, 100 naira in a large multinational company is inconsequential. So such risks should not waste the auditor's time. It doesn't mean you shouldn't attend to it, because small pilferings or missing money like that could culminate in bigger ones, but then don't waste your time, just address it and move on. So the audit application about this is that an example could be a manufacturing company, for example, that deals with manufacturing from raw materials to finished goods. Talking about the risk of raw material price fluctuations, you need to categorize them from high impact and high likelihood, which is category 1. And the auditor checks inventory valuation and supplier contracts. It's very important. Another risk of cyber attack disrupting operations has high impact but maybe low likelihood. With strong IT security, that could be addressed. And category 2, the auditor's review on IT risk management is key. Where companies gravitate towards digitization, high digital presence, tech savviness, the auditor needs to prioritize its IT risk management and risk assessment in that organization very, very critically. Also, risk of frequent travel expense errors, which is low impact but high likelihood, which is category 3. Attending to read through spot checks on staff expense claims will be able to mitigate such risk. Then the risk of losing a small supplier contract, which has low impact and low likelihood, may not affect audit opinions significantly, which is category 4. So categorizing these risks based on their high, medium, low threshold would help put proper perspective to auditors in helping to evaluate risk properly. So the key takeaway is that auditors prioritize risk by materiality and the probability of its crystallization. So focus is strongest on the highest risks, while the lowest risk may require little or no audit effort. This is very important in understanding risk, evaluation, and management. All right, any questions on that? Just rounded off section 5. Any questions? I think it's clear and succinct enough. Let's look at section 6, the advantages and disadvantages of the business risk approach. The advantages about this approach is that the better understanding of a client business is enhanced. The auditors gain deeper knowledge and improves judgment on the financial statement. So the knowledge of the business from that risk perspective, it's what enhances or makes the business move forward, or the auditor moves forward in providing judgment on the financial statements. It also keeps the auditors updated It's useful in fast-changing environments, fintechs, tech companies, banks in the finance space and all that, because it helps them focus on real risks. Research shows major audit issues often stem from business problems, not just control weakness. Major business problems that decisions have not been made could culminate in business crashes. So the auditors stay updated and focus on real risks. Another advantage is that it adds value to clients because the auditor can provide insights and recommendations to improve performance. One thing about risk management is after looking at the audit impact or the impact of such risks that are assessed, recommendations could be provided to management, and once it's implemented, they see positive results. Internal auditors, internal and external, are not just seen as control people or policemen nowadays. They are trusted advisors. They provide advice, strategic partnership to businesses and management to help move the company forward with such recommendations. So if implemented, if management accepts and implements, it improves performance and culminates in cost savings, reduced need for extensive detailed testing, especially with junior staff, because such recommendations have been implemented and then it improves the risk culture of the business. It also helps enhance competitive edge because it's seen as a modern approach that differentiates the audit firm. So the business risk approach is advantageous because you don't just look at the financial statements, but you look at issues that could impact the financial statements negatively. So firms that use this approach are much more competitive in the audit space. And the disadvantages are provided here. We have them as some of them require senior expertise, experienced management partners. And where most of these big firms hardly engage in small audits, this may have some drought because they will send some of their maybe medium-sized or little upcoming trainees to attend, and so they may not be able to provide required expertise. So these are disadvantages of this business risk approach, where junior members may not be able to handle this expertise. And they're actually expensive resources. Well, you see that most big four channel their resources, their big brains to larger size audits space or audit companies, clients. So the disadvantage is that actually some of this business risk approach requires senior expertise or partners in the firm or managers of audit firms to be able to handle. Another disadvantage is threat to independence. Closer involvement with client strategy may create perception of risks. Yeah, so there has to be a thin line and a check on the threat to independence, because it could familiarity and all that could come so close. You're advising businesses, they are seeing the results, and you may be the independence threat is there. So another disadvantage is too broad for some auditors. Some prefer the comfort of the system-based approach, maybe because they don't maybe understand the business. They just feel let's run to the system-based approach, which focus directly on financial statement figures. Yes, some auditors don't want to go into detail nitty-gritties of the business. So these are some disadvantages, especially medium-sized and small audit firms. They just want to give you their opinion on the financial statements, collect their fees, and go. So it may be too broad for some auditors, which is a disadvantage. Someone will look at it as is best suited to large companies because they attract more of the expertise, the brain, the big managers. So it may not be practical or efficient for small businesses with smaller risks. So these are some disadvantages. So a quick example or scenario, a large bank audit. The business risks highlights risks like cybersecurity threats, regulatory fines, economic issues. So these are more relevant than just testing thousands of loans or transactions posted, withdrawals and credits and all that. So a larger bank would gravitate towards this business risk approach and align better. But a small family shop audit The business risk approach is an overkill, just wasting your time. Just simple testing of their few transactions at the end of the year will work better. So the business risk approach will align more with larger firms. And the key takeaway is that the business risk approach is forward-looking, is strategic and value-adding, creating value and sustaining that value. But it demands experienced staff, careful independence safeguards, and is more efficient and effective for large and complex clients. So that's a key takeaway, and that's the end of the advantages and disadvantages of the business risk approach. Any questions to that? Or any contribution, any observation? Feel free to share your thoughts. Okay, so let's run to section 7 of the same unit 3, the comparison of a business risk and the financial statement risks, which is somehow tested sometimes in the AAA paper. So the business risk is a risk that the entity will not achieve its objective as a business, operational, tactical, compliance. So anything that will bedevil or stop the business from achieving its objective is a risk. So broader in scope, focusing on threats to the business model and the business strategy, generally strategic direction. You need to look at that generally as a business risk. The financial statement risk talk about risk that the financial statements are misstated due to errors or fraud, and narrowing it down to focusing on the accuracy, fairness of reporting. Very key. So that's the key difference. So business risk is holistic, while financial statement risk is directly tailored to the financial statements. It's not holistic. It's streamlined. So the connection between the two is that business risk often flow into financial statement risk because the business activities is what culminates into the process and the input into the financial statements. So the business risk is the vehicle that drives the financial statements risks. So for example, a declining product sales or declining revenue may lead to inventory obsolescence, culminating lower revenue, overvalued assets, and even going concern issues. Because when you're not selling a product, you're heaping up inventory, and the inventory becomes either expired or obsolete, and your inventory is overstated, overvalued, and you begin to have issues, especially for a manufacturing company that deals on inventory. Another example is weak internal controls, internal business risks, higher chance of misstatements of fraud in the financial statements. Where you have weak internal controls from the control environment, risk assessment, control activities, information and communication, monitoring, then you have a problem with the product, and it will lead to negativity or chances of misstatements in the financial statements. So a quick illustration for you is that a business risk, for example, a company depends heavily on one big customer, and that customer pulls out or cancels, terminates their contract. Then the financial statement is that receivables become uncollectible for that business, leading to overstated assets and misstated profit. That's the risk. So this business risk of a business pulling out, you can see how it culminates in receivables either going bad and uncollectible, overstated receivables, or the current assets and misstated profit. You can see the impact. So a key takeaway is that business risks are broader and strategic and can threaten the survival of a business. So we are trying to see to the going concern, let the business be sustainable, and that's what business risks address, or business risk assessment, evaluation, and treatment addresses. While financial statement risks are narrower, they directly affect just reported numbers and figures in those books. So we need, as auditors, to trace how business risks can translate into misstatements in the financial statements. And that's generally what business risk is all about. So in comparing both of them, you must understand where they are coming from and what is their value, what they are, the value proposition of both. So business risk is broader, financial statement risk is narrower. Please take note of that. Okay, so that will be the end of that unit. Any question on that? We seems to be running, but then we don't have much time. So we need to really run. Any questions? Any observations? Any contributions? We just rounded up the last unit. We want to move to the next unit. Any questions? We're quiet. Is it because we have the slides with us on our phone, on our handle? Maybe we are following through very seamlessly, right? Nobody's asking any question.
No, sir. Good yes,
yes, following.
Oh, okay. Fantastic.
We're
That's good to
following,
hear.
sir. But then I wanted to ask, sir.
Sure, please feel free. Don't
Okay,
hesitate.
I wanted to ask, what does this prospective financial information has to do with business risk? Prospective financial information, from my studies, it shows it's one of the tools that is used in a business risk, usually to check the futuristic decisions or something about business risk of an organization. So I really want to get that. I don't know if you can help throw a bit more light about that PFI.
Oh, okay. Thank you very much. PFI is actually not in this topic, but we'll come to that. And it's a good question because in reading, those things are intertwined, they are interconnected. And we need to provide context and provide clarity to that. So it's good. So please, as you're reading, take note of anything that comes to your mind and questions that will help your understanding of any subject matter. So thank you for bringing that question up. So prospective financial information is essentially financial data prepared for future periods. Yeah, it can include forecasts, projections, budgets, or any financial statements that predicts future performance. So when it comes to business risk, the PFI plays a critical role. And it plays a critical role in the sense that first thing it plays critical role is identifying business risks. And business risks, you are proactive. It's not that something has crystallized and you're trying to react to it. No, you are proactive. You are envisaging the future. So the first thing prospective information does in the area of business risk is identifying business risk. The PFI requires assumptions about market conditions, operations, and financial performance. So by preparing prospective financial information, management explicitly identifies potential uncertainties that could impact revenue, costs, cash flow. So for example, if a company projects sales growth in a new market it just entered, it must consider risks like regulatory changes, competition from other substitutes, or supply chain disruptions. So identifying business risk is important, and one of the areas PFI play a key role. Then the second area I would share some thoughts around is quantifying the impact of the business risk. So the PFI can model different scenarios. It can model best case, worst case, most likely case to assess the impact of risks on financial outcomes. And this quantifying of the impact of the risk allows businesses to estimate losses or gains under varying risk conditions. So, for example, a forecasted 10% increase in raw materials for maybe a manufacturing company, forecasting like 10% increase in raw materials costs, especially in an economy where it's heavily dependent on imports, can show its effect on profit margins. So that kind of assessment, PFI helps to provide clarity on that. And I think the third area PFI helps, and if it's used to assess business risk, is the area of risk mitigation and planning. The PFI helps to manage, or management can develop strategies to mitigate risk with the PFI. So, for example, projected cash flow shortages may prompt the business to secure either credit facilities, overdrafts, or adjust their spending. So, for example, the PFI showing potential liquidity issues, liquidity issues for their day-to-day business, running working capital and all that, may lead to implementing stricter credit control policies. So if they envisage that, the PFI helps them to put mitigants in place to avoid liquidity challenges. Another area is supporting decision making. Yeah, the PFI could help support decision making in the areas in investors making investments, lending, and internal management relying on PFI to assess risk exposure before making decisions. So supporting decision making can PFI can help decide whether to invest based on what they've projected, or lend or adjust operations based on the anticipated risk. So an example in this area, like a bank may analyze their projected financials to determine whether a company can service a loan if market conditions worsen, something like that. And I think finally, monitoring. PFI can help monitor and update risks. PFI is not static because by comparing actual performance against projected financials, businesses can identify emerging risks, adjust forecasts, improve risk management processes over time. So, in summary, PFI is actually a proactive tool that connects financial expectations with business risks, and it helps management quantify, plan for, and mitigate risks while aiding stakeholders in decision making. So these are some thoughts I will share because it's a very good question, and it could show up in the exam, PFI and business risk, because business risks are stuffs you look at proactively, and PFI is also data prepared for future periods. So thank you for that fantastic question. But I hope I didn't complicate the whole conversation. You're able to catch some thoughts on that.
Thank you so much, sir. I got that.
Okay. Fantastic question. Thank you so much. I think Mike was trying to ask one, or just made a comment. Hello, Mike. You were trying to say something.
Let's continue.
Maybe. Sam?
Let's proceed. Let's continue.
Okay. All right. So let's look at the system-based approach. Talking about 10 sessions, quite long sessions, but then we'll try to be brief. So we'll be looking at the nature of system-based approach to an audit, what makes an effective system of internal control, talking about the control environment, risk assessment, information system, control activities, monitoring. So this makeup of these five they are the 5 components of internal control based on the COSO framework. We'll be looking at it in these sessions. Then we'll be looking at how the auditor uses internal controls and the auditor's evaluation also of internal controls. Then we'll summarize the approach to reliance on internal controls. Okay, so we have 8 more minutes wherever it is. We'll stop once it's 9, so we could take a short break. All right, how come my screen went back? Did my screen go back? Just a minute, let me see. Oh no. Okay, it didn't go back actually. All right, so let's look at the first section, talking about the nature of system-based approach to an audit. Now, speaking to a system-based approach to an audit talks about the client's internal control system generally and whether controls are strong and enough to ensure reliable financial reporting and operational efficiency and also compliance. Somebody will ask, what are internal controls actually? Somebody may ask, what is this internal control? Somebody is talking about always internal controls. Internal controls. What are internal controls? So let me explain internal controls briefly. They talk about policies, procedures. Well, some of us know them as SOPs. Policies, procedures, and activities put in place by the organization and management to ensure that, number 1, operations are effective and efficient. Number 2, financial statements or reporting is accurate and reliable. So, number 3, the organization is compliant with laws and regulations and internal policies. 4, assets are safeguarded from loss, fraud, and misuse. So internal control, again, are policies, procedures, activities. Those three words, policies, procedures, activities, should come to your mind once you hear internal controls. And those are to be put in place by the organization's management.
Your slide is not
it's not
it's not
toggling.
actually where it should be, yes, because from my own end, I'm seeing definition of internal system-based approach while you're talking about internal control. So I don't know if it's from my own end.
No,
That's just a
I'm just sharing
digression.
thoughts. It's a digression. I'm
Oh,
just sharing
okay.
thoughts on internal control system. So it's
Oh,
not on
okay,
this
okay.
slide. I just want somebody to
Oh, okay.
understand, because the definition said system-based approach. So somebody may be thinking, what are internal control? I just want to put proper context to what internal control is. So sorry, I digressed.
Okay.
All right. So
It's not
just a
digression.
brief.
The system-based audit approach really talks about the internal control system,
Exactly.
basically. So it's still part of
Exactly.
it, I guess.
Yeah, no, you're right. You're right. That's it. You're not guessing, you're right. So I just provided context to internal controls. But at this stage, they believe, the ICAN believe, or the ICAN study text believe you should have known what internal controls is. So let me just refresh us on what internal controls is. That's why I went back. So looking at financial reporting, operational efficiency, and compliance is what internal controls should address. And it matters because ISA 315 provides clarity, and auditors must understand the entity and its environment. So in carrying out your audits, if you don't understand the business, its entity, and the controls, you may not be able to audit that environment, which includes the internal controls to properly assess risks of material misstatements, which is very important. So the role of management, which is a primary responsibility, is that they must design and implement effective controls. Very important. Good controls should culminate and ensure reliable financial reporting, effective and efficient operations that provides some comfort that integrity is embedded in them. And also good internal controls should ensure compliance with laws and regulations external, and it's also compliant with laws and regulations internal, talking about SOPs, policies of the organization. So the auditor's assumption always is that if systems and controls are effective and controls are strong, then transactions are processed correctly, which is true. And that general assumption is correct. I went to our parent company in my former place of work, and the auditor was saying, oh boy, control strong here. Control strong here. The 3 lines of defense are very strong. And you see, that attests to the fact that financial reporting and financial statements will always culminate in that comfort. If controls are strong, the first, second, third line of defense are adequately operating. I mean, internal control system, there will likely be reasonable assurance that everything works properly. So the transactions are processed correctly, and financial statements will likely be true and fair. That's the assumption of auditors. So the focus on testing controls rather than testing every transaction is important. So when you test controls, of course, you may not have issues with testing transactions. Yes, please, Grace, go ahead. I can see your hand. Yes,
So
Grace,
you
go ahead.
talked about first, second, and third line of control.
Defense.
What are, defense, yeah. What are they? What are these first, second, and third line of defense in internal control? What are their examples?
Okay. They are not internal controls. They are actually a third line. It's not actually third line of defense. That third line of defense has been changed. It's now 3 lines model. Because when you say third line of defense, the Institute of Internal Auditors instituted that model. It's actually a model. So the 3 lines model from 2020 is no more called 3 lines of defense. It's now 3 lines model. What it means is that they are like protectors. They are like guards for an organization. So we have the first line, we have the second line, and the third line. So the first line are process owners. So for example, you have departmental heads that oversee a unit, finance unit, sales unit, human resource unit, production unit. All those units, they have a head, and that head should be the first line of defense. So those process owners that bring the risks are called first line of defense. So for example, transactions are going on. The unit finance manager should be able to put proper mitigants in place to address any risk of financial misstatement. So he's the first line of defense. The finance manager in the finance unit is the first line of defense. The human resource manager of the human resource unit is the first line of defense in that unit. So for each unit, the head of that unit is the first line of defense. Then the second line of defense, based on the IIA's model, which is the Institute of Internal Auditors, is risk management and compliance. So whatever passes those unit heads should not pass the risk management. Risk management should stop it. So for example, transactions have gone. When it gets to risk management or compliance, that unit should be able to target and say, no, look at this posting, look at this, is risky, blah, 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 blah. These transactions don't comply with our standards. This has not been done. So that unit, risk management, compliance, some organizations have internal control unit, should peg it. Then the third line of defense is internal audits and external audits. So internal audits is a third line of defense because it assesses the functionality of the first line and the second line. If anything passes the first line, passes risk management and compliance, it shouldn't pass internal audits. If it passes internal audits, it shouldn't pass external audit. So these safeguards is what the Institute of Internal Auditors provided as a model, and it's called the 3 lines model. So when we say 3 lines of defense, these 3 guards in the office, in the organization, talking about the managers, unit heads, departmental heads, then move to risk and compliance. Bigger organizations have a separate risk unit. Some even have them plenty, 5, 10 risk people in that unit. Then you have internal audits. Some people may have 5, 10, or 1, depending. Then they'll have external audits. So these are the 3 lines of defense. Internal and external is in the same third line. Risk, compliance, internal control, second line. Then unit heads, first line. So it's a model by the Institute of Internal Auditors. I hope it's a bit clear to you, Gracie.
Yes, thank you.
All right, you're welcome. Okay, so if the systems are effective and like I said, the 3 lines of defense are in place, then financial statements will likely be true and fair. So they focused on testing controls to see if those controls work than transactions is better for internal or external auditors. So audit steps in the system-based approach includes, number 1, identify key systems and controls, especially as it speaks to that organization. Wow, it's 9:01. Okay, please let me land, then we'll go on break. Pardon me, let me don't stop. Let me don't hang on the air. I'll just land, then we'll go on break, please. So the audit steps in the system-based approach talk about identifying key systems and controls. So for a bank, you look at what are the key systems and controls in that bank and how do they matter. Then you need to evaluate their design. How are they designed and if they are working? Some have good design controls, but they don't work. Excuse me. Then when you have understood the design and how it works, then you test whether they are actually operating effectively. In testing transaction, if there's a policy in place that says somebody walks in, you register before you pay, you have to assess and test whether that procedure is actually working. Somebody comes in, he doesn't register, he just goes to pay, or he just comes in and goes to access the service. You need to test it if it works. So you need to also rely on the controls, whether they are strong. So it will determine whether you do substantive test or that little compliance testing is sufficient. So for example, a bank audit, instead of checking every loan issued, the auditor can test that the loan approval system controls work. Each hierarchy or amount of loan is approved by a particular kind of person. And if you've seen the hierarchy of controls, that 1 million is approved by this manager, level manager, 5 million is approved by this level manager, you test 1 or 2 loans given and you see it culminates, it may not need going through detailed testing. So examples are proper credit checks, authorization and segregation of duties in the area of loan and credit disbursement. So the assumption is that if controls work well, there is less need for testing individual loan details. So key takeaway is that system-based approach saves time and cost by focusing on actually the internal controls or the controls, but its reliability depends on whether the controls are strong and actually working. If they are not strong, then detailed testing will be the order of the day. All right, so that will be the end of the first session, and we'll have to go on break now. Do we have any questions?